Federal Reserve Governor Michael Barr just invoked the panic of 1907 when talking about stablecoins, and if you understand what that means, you know we're standing at the edge of either the biggest opportunity or the biggest disaster in crypto history. Barr didn't choose that reference by accident. The panic of 1907 wiped out 50% of stock values in weeks, triggered a recession that lasted 2 years, and fundamentally changed how America thinks about banking forever. And now he is saying stablecoins could do the same thing to our entire financial system. Here's what's really happening behind the scenes. The Fed just released new guidance on the Genius Act implementation, and buried in the technical language is a warning so severe that it should make every crypto investor pause. But it also reveals something massive about where this market is heading. In the next few minutes, I am going to break down exactly what Barr said, why he chose the most devastating financial panic in American history as his comparison, and most importantly, what this means for your portfolio right now. Because while everyone is focused on Bitcoin price action, the real story is happening in stablecoins, and it's about to reshape everything. Let me start with the numbers that should terrify you. The current stablecoin market is sitting at $170 billion. That's more than the entire GDP of Hungary. Tether alone processes more daily volume than Visa. And here's the kicker: most of these stablecoins are backed by reserves that nobody has fully audited in real time. Barr specifically called out 3 risks that mirror exactly what happened in 1907: bank runs, weak reserves, and what he termed systemic contagion risk. In 1907, it started when depositors lost confidence in just one bank, Knickerbocker Trust. Within days, that panic spread to every major financial institution in America. Now imagine that happening with USDT or USDC. These aren't just digital dollars, they re the backbone of the entire crypto trading ecosystem. Every major exchange relies on them. Every DeFi protocol needs them. If confidence breaks, everything breaks. The Genius Act that Barr referenced stands for Genuine Innovation Using Stablecoin Networks in U.S. Sovereigns. It is supposed to create clear regulatory framework for stablecoin issuers. But Barr's warning reveals something crucial: even with regulation, the Fed sees massive systemic risk. Here's what most people missed from his statement. He said clearer rules could help the market grow, but then immediately followed with warnings about runs, reserves, and illicit finance. That's Fed speak for we want to regulate this, but we're scared of what we're re-regulating. Let me give you some context on why this matters right now. Last month, Circle had to freeze 75 million USDC after sanctions compliance issues. It was handled quietly, but imagine if that was 75 billion during a market panic. The entire crypto market would seize up in minutes. Tether has faced similar pressures. Despite being the largest stablecoin, questions about their reserves persist. They claim full backing, but their reserve composition changes quarterly, and during market stress, that composition matters enormously. The 1907 comparison isn't random. In 1907, banks operated with fractional reserves, just like many worry stablecoin issuers do today. When confidence evaporated, everyone wanted their money at once. Banks couldn't meet redemption demands. Sound familiar? If you're finding this analysis valuable, smash the like button. It genuinely helps more people see this critical information. Now let us talk about what this means for the broader crypto market, because the implications are staggering. First, if stablecoin regulations tighten significantly, trading volume across all exchanges will drop. We're talking about potentially 40 to 60% of daily crypto volume that flows through stablecoin pairs. That's billions in liquidity that could evaporate overnight. Second, DeFi protocols would face an existential crisis. Most yield farming, liquidity provision, and lending protocols rely heavily on stablecoins. Stricter regulations could force many protocols to completely restructure or shut down. But here's where it gets interesting. Barr also said clearer rules could help the market grow. Translation: the Fed wants controlled growth, not explosive growth. They want stablecoins that behave like actual banks, with actual reserves, actual oversight, and actual limits. This creates a massive opportunity for compliant stablecoin issuers. Circle has been positioning USDC as the regulated stablecoin for months. If new rules favor fully reserved, fully audited stablecoins, USDC could capture enormous market share from Tether. The numbers support this theory. In institutional trading, USDC has been gaining ground consistently. Major crypto trading platforms like Coinbase already favor USDC in their professional products. If regulations push institutional adoption, USDC could flip USDT within 18 months. But here's what really matters for your portfolio. Fun fact, 80% of you watching aren't subscribed. If you want to stay ahead of these regulatory shifts that could make or break your investments, hit that subscribe button now. Diversification in stablecoins is about to become critical. Holding only USDT or only USDC creates concentration risk. Smart money is already spreading across multiple compliant stablecoins and even exploring alternatives like BUSD and FRAX. For crypto trading, this changes everything. If stablecoin regulations create friction in trading pairs, Bitcoin and Ethereum direct pairs could see increased volume. That means potentially higher volatility in major cryptocurrencies as traders adapt to new market structure. Options markets are already pricing in this uncertainty. Bitcoin volatility premiums have increased 15% in the past month, partly due to stablecoin regulatory concerns. Smart traders are positioning for increased volatility across all major crypto assets. Real estate tokenization could benefit enormously. If traditional stablecoins face restrictions, asset-backed tokens could emerge as alternatives. Companies tokenizing real estate, commodities, or other assets might see unexpected demand. Central bank digital currencies become more relevant. The Fed's concern about private stablecoins strengthens the case for a digital dollar. If you're not already thinking about how CBDCs affect your crypto investments, you're behind the curve. Here's your action plan based on this intelligence. First, audit your stablecoin exposure immediately. If you're holding large amounts in any single stablecoin, especially for long-term storage, diversify now before regulations force uncomfortable decisions. Second, consider the regulatory arbitrage opportunity. Stablecoin issuers that proactively comply with likely Fed requirements could see massive inflows. Circle, Paxos, and other regulated issuers might outperform broader crypto markets. Third, prepare for increased volatility. If stablecoin trading becomes more complex, crypto markets will become choppier. That creates opportunities for skilled traders but increases risk for casual investors. Adjust your position sizes accordingly. Fourth, watch international developments. If U.S. stablecoin regulations become restrictive, crypto activity might shift to friendlier jurisdictions. Singapore, UAE, and Switzerland are already positioning as crypto-friendly alternatives. Fifth, don't ignore the institutional angle. Major financial institutions are watching these developments closely. If regulations provide clarity without killing innovation, institutional adoption could accelerate dramatically. The 1907 panic ultimately led to the creation of the Federal Reserve. Barr's warning about stablecoins might lead to equally transformative changes in how we think about digital money. This isn't just about regulation, it's about the future architecture of global finance. Stablecoins represent the first real challenge to traditional banking in over a century. The Fed's response will determine whether that challenge evolves into partnership or conflict. Smart investors position ahead of regulatory clarity, not after. The stablecoin shakeup is coming whether we're ready or not. The question is whether you'll profit from the transition or get caught in the turbulence. Drop your stablecoin strategy in the comments. I read every single one and respond to the most thoughtful insights. Are you diversifying across multiple stablecoins, going all in on the most regulated options, or planning an exit strategy? Let me know your thoughts. Make sure you check out my deep dive on central bank digital currencies next. It connects directly to everything we just discussed and reveals the Fed's real endgame for digital money. The link is in the description, and trust me, after watching this, you'll want to understand what's coming next.